40% of your 401k could belong to someone else, and the statement will never tell you. At a 22% retirement tax rate, almost a third of every pre-tax dollar in there is the IRS waiting in line. The pitch for the Roth IRA is almost always the same one sentence: tax-free growth. And that sentence has done more to confuse retirement planning in this country than any other piece of advice I can name. Not because it is wrong, because it is the second best argument for the account. If you are earning $50,000 to $150,000 a year, I want to hand you 3 structural advantages your calculator is not showing you. 3 moments in your life where the 401k says no and the Roth says yes. The first one shows up roughly 25 years before you ever plan on touching the account. Start with the conventional case. The 401k pitch is real. You contribute pre-tax. On a $75,000 salary, contributing $7,500 saves you about $1,650 in federal taxes every year. Real money. Let that sink in for a moment. But when you finally pull it out, every dollar you put in and every dollar of growth on top gets taxed as ordinary income. Not capital gains, ordinary income. Picture a guy named Jake. 10% contribution, 4% match. $10,500 a year into his 401k. By year 10, the account has roughly grown to $145,000 at a 7% return. Jake owns about $113,000 of it. The rest he rents from the government. That is the deferral story. Now let me show you what the fight is missing. Lever 1, your Roth contributions, not the earnings, the contributions, can come out at any time, at any age, with 0 tax and 0 penalty. That rule has been in place since the account was created. You are 48, the transmission goes, you need $30,000 this week. From a 401k, you pay a 10% penalty plus ordinary tax, $3,000 in penalty, $6,600 in tax at a 22% rate. Almost $10,000 gone before the mechanic touches the car. Same withdrawal from a Roth contribution basis, 0 penalty, 0 tax. You might be thinking you should never raid retirement money, generally true. Treat this door as insurance, not a checking account. The point is you have it, the 401k does not. If anything you just heard made the decision feel sharper, drop your bracket in the comments below. Lever 2. At a certain age, and this matters more than people realize, the IRS forces you to take money out of your 401k whether you need it or not. They are called required minimum distributions. The Roth IRA has no such requirement, ever. If Jake's 401k has grown to $2.6 million by then at a steady 7% return, his first forced withdrawal is roughly $98,000. He has to take it, he cannot defer it. And once that hits his income, the trapdoor opens. Up to 85% of his Social Security benefits become taxable because his combined income now blows past the threshold for single filers. On top of that, Medicare Part B and Part D premiums get an income-related surcharge called IRMAA above certain income thresholds. Jake gets hit there too. Higher Medicare premiums, higher Social Security taxation, all triggered by a withdrawal he did not want to make. Marcus, with his Roth, takes out exactly what he needs. His RMD is 0. He is invisible to the system on his own timeline. If that hits home for you, go ahead and hit the like button. Lever 3, you die. Stay with me for 30 seconds. Under current federal inheritance rules, if Marcus leaves his Roth to his kids, they withdraw the full balance within 10 years. They owe 0 federal income tax on a single dollar of it, as long as the account was open long enough to qualify. Jake's kids inherit a 401k. They owe ordinary income tax on every dollar within the same 10 years. Now here is the absolutely cruel part of this whole equation. Jake's kids are usually in their 40s or 50s when they inherit. Peak earning years, highest brackets of their lives. $1 million 401k inheritance, withdrawn on top of their existing salaries, can lose a quarter to a third of itself to federal tax. $1 million Roth, they keep the whole million. 3 doors the Roth opens that the 401k locks. Contribution access, no forced withdrawals, tax-free inheritance. Tax-free growth is the marketing, optionality is the product. Now in fairness, the 401k has real advantages. The employer match is the highest guaranteed return in personal finance. Free money you cannot get anywhere else, year after year, compounding for decades. The Roth simply cannot replicate that kind of return. The contribution ceiling is the other real advantage, way higher than the Roth annual limit. That space matters if you are a saver who wants to shelter more of your income. The Roth has its own walls too. The phase-out hits high earners. There are no future tax rate guarantees from anyone. Federal debt levels alone are an argument for owning both account types, not just one. If this changed how you weigh the trade-off, subscribe to keep these coming. So here is the move, 3 steps in order. Step 1, contribute to your 401k up to the full match, free money always. Step 2, max your Roth IRA at $7,500 in 2026, or $8,600 if you are 50 or older, if your income is below the phase-out. Step 3. Only after those two are done, push your 401k contributions toward the higher annual limit. The match buys the guaranteed return, the Roth buys the 3 doors. The 401k space buys the tax-deferred volume on top. Run your specific numbers past a fee-only fiduciary before you act. The Roth's tax-free growth is not the reason it wins for most middle earners. The 3 doors are optionality is the meal. What does it actually take to retire on your own terms using these accounts in the right sequence? I am walking through that one next. See you in the next one. Take care.